Hello everybody, this is Toni Turner and welcome to the market now as of about noon Eastern on Friday, May the 4th. Well, U.S. stock indexes are higher so far today as the Labor Department reported that the unemployment rate dropped to a 17.5-year low. Apple rose 2.4% after Warren Buffett's Berkshire Hathaway raised its stake in the iPhone maker. The Labor Department's jobs report showed non-farm payrolls increased by 164,000 jobs last month, while the unemployment rate was down to 3.9%. Pretty good. And on that note, excuse me, let's go on and look at three charts that will give us some insight into the week to come. Now, first of all, as we always do, we're going to look at a daily chart of the S&P 500 Spider. This is the exchange-traded fund that closely follows our S&P 500 benchmark index. And as we know, the SPY made an all-time closing high at $286 and change on January 26th. Since then, as you know, we've had a very volatile ride all the way down to the 200-day moving average, down to about $254, then back up, then a little mini double top here, then a fall down back from that, down in March, back down to the 200-day moving average. Now that's the black line on this screen that's been a very important support level for the SPY since almost the first of the year. So note this 200-day moving average. We came back down to it in February. We came back down to it in the end of March and April, down to this 258 zone down here. You can see the trend line I've drawn, and you can see the 200-day moving average acting so far as a strong support level. So thank goodness for that. So far today, the SPY is rallying once again off of the 200-day moving average. I captured this chart. It was trading at $264.55. Yesterday was a real nail biter because early in the day, the SPY fell below the 200-day moving average to an intraday low of $259.05. Again, today, so far, we're rallying again, as I said, back up to 264.55. Now it would be, excuse me, still below the the red line, the 20-day moving average, and of course still below the 50-day moving average, which is coming in right now at 267.71. Now the SPY has quite a bit of work to do to see if it can, in the last week or so of earnings reports, if it can rally back up. We're in this triangle mode again that you can see. It will be important to see if the SPY has the legs, especially as we're going into May, which can sometimes start a little weakness as the summer months bring about low volume. But we'll see here if the SPY can climb back above this 50-day moving average, again at 267.71. Then, importantly, can it climb above this 271 range in here, which is prior resistance, price resistance from earlier in April, and we have this overhead channel line coming down. So the SPY's got work to do. Let's see if it can bounce back up, maybe on the back of some tech stocks, which are looking like they're steadying out here a little bit. Of course, if the SPY rolls down below $261, the 200-day moving average, and below the short-term trend line, then we could see a fall down a little closer to 250, which would be to 2,500 on the S&P 500 itself. So we're at a very important point here, and next week will be very interesting to see if the SPY can rally or if it weakens again. Our next chart today is a chart of the iShares Russell 2000 Exchange Traded Fund. We're looking at that this chart today. As you all probably know, I've told you before, the iShares Russell 2000 Exchange Traded Fund follows the small caps in our stock market. The small caps are companies valued at about $300 million to $2 billion. And the the IWM is capable as acting as a leading indicator for the broader markets. As I like to say, it's much more dramatic than the SPY. It tends to move up higher and faster and down faster and lower. And as you can see from its all-time highs up here, we had an all-time high at about $160 on the IWM. Then, like the SPY, it rolled down to the 200-day moving average, only rallied higher again, up to nearly its past high at 160, unlike the SPY that stayed lower. Then fell back down again to the 200-day moving average. But this past week, when the SPY fell so hard, the IWM did not. So it sees promise here, and we like that. The IWM today is trading, when I captured this chart, just above the 20-day moving average and the 50-day moving average. It's trading at 154.85. So in the coming week, it will be important to see if the IWM has to fall back down below this real short-term trend line here, back down below to its 200-day moving average and the trend line right at it, below it, possibly falling below these two support levels, then we could see another leg lower. But if the IWM is positive today, of course, again at 154.85 right now, if it can rally up off of this support level here, stay above the 50-day moving average, that will be positive for the overall markets. So let's keep an eye on the IWM in the coming week, again, as it can act as a leading indicator for the bigger market, the broader market. Our final chart today is a chart we haven't looked at in a while. This is the First Trust Cloud Computing ETF. The SKYY is the symbol. There are 30 holdings in the SKYY. The top holdings are Netflix, Amazon, Red Hat, Akamai, and F5 Networks. I'm sure you've heard of all those. And before we start, there's a little trading lesson on this chart. It's evident in the past two charts that we looked at, but I thought you could see it very, very clearly here. Notice, look left with me on the chart, and notice how SKYY walked so beautifully up its 20-day moving average, except for a slight hiccup here last December, but basically walked above this 20-day moving average. Look how orderly the candles are. Note how most of them are very small range days. So this is a cheerful walk up this 20-day line until we get up into January, which is pretty much toward the end of January when the volatility started in the broader market. Now notice the difference between the candles. The candles here that are rising up the 20-day are orderly, are narrow range candles, and then all of a sudden things change. Then the SKYY, and truly along with most other ETFs and indexes that are sector-based, fell dramatically. And look at the difference in the candles. Look how wide they are here. Look how wide these are. Now when we see candles like this, they are volatile. Their highs are higher, their lows are lower. The average true range is climbing. They're getting volatile. This signals that the bulls and bears are fighting. So whenever I see volatility come into a long-term trade that I have, whenever I see volatility like this, I know that it can mean the bulls and bears are fighting, and it could mean that it's going to head lower at least a few times until this gets straightened out. And that's exactly what happened. And it happened with a lot of other indexes. So note that the range of the candle stays wide through March, certainly into April. And so that means that we could get all kinds of surprises to the upside and to the downside. Whenever this happens, I reduce my share size with that particular stock or ETF, and it can happen with stock prices and does as well. This volatility usually notes change. And certainly there was a change in the pattern of the SKYY as compared into earlier this year and late in the last year when it was so orderly. So this is when you have to get careful when you get this wide volatility. In the last 3 weeks, it's remained above the 50-day moving average. A couple of days ago, the 20-day crossed above the 50-day. That's certainly a mild positive. And we see that the SKYY is attempting to climb out of the triangle that it has been literally enduring for the last couple of months. Now today it climbed to 50.82. As you can see, it's trading above its 50-day moving average. If the SKYY, and it has some good stocks in it as I just read to you, the SKYY in the coming week, if it can stay above its 50-day moving average here, I may add shares to my portfolio. Of course, I will have my initial stop below as a close below the 50-day moving average, which is now coming in at 49.75. Again, the SKYY is right now at 50.82. If it can continue up to, say, 51 or so next week, I may add shares, as always, with my initial stop as a close below the 50-day moving average. The RSI here is moving a little higher. The MACD is positive and above the zero line. So you may want to keep an eye on the SKYY as we move into this coming week. And now let's go on to this coming week's economic reports. But first, please join us this coming Monday, May 7th, for our next session of Toni's Market Club. We'll talk about which side of the market to trade, have a mini trading lesson, and I'll give you stocks and ETFs that may become ripe for high potential trades. This is a low-priced, high-value opportunity to learn more about the market, become a smarter trader, and make more money. So please join us. For those who cannot attend our live session, not a problem. The recording of our session is available to all of our members just a few minutes after the session ends. For more information and to join, go to tonysmarketclub.com. Now, we're still in earnings season, but it will start tapering off a little bit in the coming week. We still, however, have hundreds of companies that will report, and of course that will move the market. As well, we have economic reports, not very many next week. On Wednesday, we have the Producer Price Index and our usual crude inventories. On Thursday, we'll have the Consumer Price Index, our usual jobless claims, and our usual natural gas inventories. And on Friday, we'll have the Michigan Sentiment Report. Again, join us for Toni's Market Club this coming Monday. Don't miss out on this terrific opportunity to raise your trading skills and your trading profits. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.